banks have increased the deposit rates. Is that a one-off, or you think this is beginning of the cycle?
I don't think it's a one-off. I think banks, as you would have seen and as you heard from the Reserve Bank governor, clearly inflation is the cause of concern. There has been a bias towards tightening of the money supply. So this is, and you've had negative interest rates. So this is depending upon demand, supply, and what happens to inflation. As of now, I feel this is enough. Then we will have to watch as it goes along.
The hallmark for banks in the quarter gone by was expansion in NIMs and the fact that they were able to protect their margins. Given the fact that deposit rates are now headed up, are you confident you will be able to protect your margins?
I think so. I think that when deposit rates move up, but then with the calculation of the base rate with a lag, the base rate will also move up. So we are pretty confident about maintaining our margins in the range that we have always predicted.
So you're confident that 4% plus is here to stay?
Around 4%.
If I look at your NPA, at least for the quarter gone by, on a sequential basis, your NPAs have come down by about 1.5%. Why has that happened?
That reflects the improvement in the macroeconomic situation. So if the economy is going to grow at 8.5%, naturally the clients are going to be doing well. More people are going to be employed, more demand is there, and people are going to be paying on time. So it's a reflection of the macroeconomic conditions.
So if one has to chart the NPA pattern, do you see similar recovery at NPA level on a sequential basis from these levels as well?
I don't see further recovery, but this is the standardized recovery. This is the NPA and the provisioning level that we had under normal circumstances. It had gone up as logically it should during the period that we had a downturn. Now it will be standard at about this level.
In terms of an opportunity, the big opportunity which came for banks, at least in the last quarter, was telecom. Do you see similar big sectoral opportunities which could come for banks like HDFC?
I don't view it like that. Telecom was a short-term opportunity. It's not enough to alter the balance sheet. But I think if you look at the broader picture, if the economy is to grow at 8.5% plus, if you see what is happening in terms of the trickle-down effect and with the spending on infrastructure and NREGA, what is happening to the rural landscape, you'll be surprised as to how much money is coming in there. Then demand for financial services is not an issue. Growth, in our view, around the 20% for the system is again not an issue. And rural demand, I think, will surprise everyone.
So if you really have to characterize the three verticals, corporate, retail, and then rural, what growth do you expect in these three verticals?
The exact growth, we don't give a guidance, but corporate has been growing faster than retail currently. As the economy picks up, I think they will grow at about the same path. Our rural growth is fantastic, but that's be it of a smaller base. So our rural growth, I was in Pimpalgaon, I was in ETNow in Gujarat, I was in Baramati, and we held melas for the 20 villages around. And I must say the demand and the opportunity and the affluence is phenomenal, and we see that as a major growth area. We are positioned on a three-step distribution scenario whereby we have a branch, we have a business correspondent, and jointly with the telecom companies will deliver into the interior. So that will be the fastest growing.
But the NIMs which you enjoy in rural lending, are they at par with your other averages?
The cost of funds actually has a downward bias as you move into the rural areas. So even if you have a slightly lower interest rate, you will still maintain your NIMs. And I must specify so that we are clear that our rural push is not resulting or requiring us in any way to lower our credit standards.
But will that be a focus area for you now?
It is. It's a major focus area. And I'd say it would have to be for everyone. If 50% of FMCG sales are there, 40% of car sales are there, most of your tea, and if you see the penetration of tea, it's 98% in rural, 99%. So that's a major growth area. Couple that with what is being spent on NREGA, which is about 40 million jobs. See what is being spent on infrastructure, irrigation, health, and the change in commodity prices, i.e. food prices, separate from the high inflation that you have. But the basic yield on food has increased. So we see a lot of prosperity coming in there. And we intend to participate in that demand. We are also participating in the microfinance opportunity to make the bottom of the pyramid financially viable.
You know, my last question is something which I've always asked you. Markets, they love surprises. HDFC Bank, they never give a surprise.
then they shouldn't invest in HDFC Bank, because we have a clear model. We've always said that demand is not a problem. We've always said that we will maintain a balance between risk-reward. We've always said we'll maintain an asset-liability match, and we maintain all of that, and we are a player on the Indian economy. So we grow at a rate that is a multiplier of the GDP growth, so approximately between 2.5 to 3 times the GDP growth. So if the GDP grows at 8.5, we will grow at 25. If the GDP grows at 9, we will grow at 27 or 30, because the velocity increases. And if the market is looking for excitement, they should go in for more exciting shares.
But 20% plus, you're confident you would be able to maintain, because so far the base effect has not kicked in for you.
I don't think the base effect has relevance in India. I've always maintained this is the best financial services opportunity. 20% is for the market at an 8% GDP growth rate. We normally grow faster than the market. And I don't see a base effect being a problem for us for the next 10 years.